Well, risk management and risk control is obviously critical to a trader's success. Our guest today is Pratik Patel. He's here to talk to us about how he uses risk control. Pratik, thanks for being here.
Thank you for having me.
All right, so what does risk control mean to you, first off?
Risk control is you want to know how much market exposure you have on any trade that you get into. You always want to know what you're risking before you actually want to get into the trade, and before you want to accept the fact that you might take a profit. You always want to know what are your place of stops to where you're going to cut the market and just say, hey, I'm done, and wait on the side, wait for your next opportunity. So one way of always controlling risk is always putting a stop. The first order we ever put is a stop order, so we know if anything happens, that's our cutoff point, and then we'll just wait and analyze the market again. Let the information come to us, and then get into the next situation.
So how do you decide where that stop is placed? Is it an arbitrary, I'm never going to lose more than 1 point, or how do you do it for yourself?
Well, we never put it on a point value or a dollar value. We look at the technicals that the markets are giving us. So we have an indicator setting up that this is where we have that retracement point we want to get in, and this is where we're going to put our stop. It's all based off pure technicals, and if there's a penetration of a support line or trend line, then you always want to stop out at that level, because then the trend will continue in that direction. If you look at the history of market or study the market movement, once they penetrate those trend lines and technicals, they'll continue to go. It could be a fake out, you never know, but you don't want to take that chance. The best thing to do is always put that stop there, know where it's going to hit, and just cut it and wait for the next opportunity.
All right, so how about when you've gone to make a profit, do you trail that stop up to try and lock in those profits?
Yes, once you get into that position, get into that neutral zone position, once let's say you want to buy it, so you go long, you know your stop, you know your exit, and so once the trend or the trade starts going in that direction, we start lifting our stops up, mitigating any kind of risk. We put it at the next technical level, then continue to go up the next technical level. So you start locking in profits and mitigating risk. Then you'll have like multiple exit points, exit 1, exit 2, exit 3. So once they're all hit, you cancel your stops, and then you take that trade off, and then you're done for the day. Oh, I'm sorry, not done for the day. Done with that trade, and then you wait for the next opportunity.
And you mentioned something called a neutral zone. What do you mean by that?
Well, the indicators that I use, you base it off your support resistance or trend lines. And if I'm looking for a buying opportunity, what I call a neutral zone, it's like we wait for that retracement. Once it comes into that zone, that's where you're going to start thinking about, is this the right place to start buying it, and this is where my stop's going to be. And also that neutral zone gives us a range, and so we can maybe capture better entry, maybe a little bit lower. So we capture 1 point lower, it mitigates our risk 1 point, but maximize our profit 1 more point. And start trailing those stops up and locking that profit. So it's all about trailing those stops, trailing your exit. So it kind of benefits everybody when you're in that neutral zone, because it kind of gives all the traders an opportunity to analyze that even better and even more, and see if that's going to be the optimal entry price.
Pratik, thanks for your time.
Thank you.
You're watching the MoneyShow.com video network.